let's go and look at, I'm not going to worry about that one. What's an account? An account is a record of increases and decreases in either a specific asset, a specific liability, a specific equity, a specific revenue, or an expense item. An account can be cash, or let's be specific, Wells Fargo checking account. An account can be Wells Fargo savings account. An account can be rent expense. What's that? An expense. An account can be note payable Martin. I owe him money. Interest expense is an account. What kind of account is interest expense? Remember my little secret? If it says expense, what kind of account is it? If it says payable, what kind of account is it? Payable or liability, right? Who's got the attendance sheet? Do you mind passing it up here? Thank you. So when we have a bunch of increases and decreases, we either debit something or credit something. Now guys, this is the most important piece to understand. For some accounts, a debit increases the account. And for some accounts, a credit decreases an account. But for other accounts, a credit increases an account. And for some accounts, a debit decreases an account. So debit doesn't always mean increase. It means left. Do you see how in this, if we have an account, the debit is on the left, the credit is on the right. Do you see that? This is called a T account. This is a way we can keep track of our transactions if we debit or credit things. Does that make sense, what I'm telling you? So let's talk about this debit and credit. We call it a dual system or a double entry system. Each transaction must affect two or more accounts so we keep the equation always in balance. You see how we were kind of seeing that visual of always keeping things equal? Well, when we get into accounts, we're going to have to always have at least two accounts that we do something with because we've always got to keep things equal. Basically, what we might do is debit one account and credit another account. We might debit two accounts and only credit one account, but they got to still be equal, don't they? Debits have to equal credits. They have to. That's why I think I like accounting. It really is pretty straightforward. It's kind of like black and white. And then you realize there's always gray in everything you do in life. But you start out being black and white. If debits are greater than credits, then this account has a debit balance. In other words, in all the accounts, debits need to equal credits. But in this particular account, if debits are greater than credits, then you end up with a debit balance. So like in this case, here the debits are $18,000, the credit is $3,000, so we end up with a balance of $15,000 here. This balance is a debit balance, isn't it? Okay? If credits are greater than debits, then the account has a credit balance. Do you see how on the credit side there's 11, on the debit side there's 10? What's our balance? 1,000. This is paramount. Assets. Always, debits should always exceed credits. Okay? Assets such as cash, such as buildings, equipment, prepaid insurance, computers. Debits always are going to be greater than credits. But what about liabilities? It's opposite. credits are going to always exceed our debits. Okay? The normal balance is the side where increases in the account are recorded. So if you think about it, when we get $2,000 cash and we borrow it from the bank, what happens to cash? It goes up. What happens to liability? Goes up. We're going to put a debit into cash, which is the normal balance, and we're going to put a credit into liability. So you kind of know when something goes up, that's going to be the normal side for them. Hang in there with me. Procedures for stockholders' equity. Investments in stockholders and revenue increase stockholders' equity because that's a normal credit balance. Think of the accounting equation, assets equal liabilities plus stockholders' equity. If assets are a normal debit balance, then liabilities and stockholders' equity need to be a normal credit balance for them to equal, okay? So if we increase our equity into a company or we have revenues, what's that going to do to our equity, our stockholders' equity account? Increase. When we take away, when we pay dividends or have expenses, what does that do to our stockholders' equity account? It decreases it. So if the normal balance is a credit for stockholders' equity, when we decrease stockholders' equity, what do? We're going to debit it. Let's go through some problems right now. What is the first problem I have on your page here? Didn't I put something up here? Let me see. I thought I did. Here it is. No, that's not it. Dropbox. Template. Here we go. How do I download that? Okay. That's not what I want. What am I doing? There. Chapter 3. Boy, oh boy. New folder. Okay, but I want to save this. If I download that, oh, I open. Okay. Little slow this morning. Had too much fun with my daughter last night. How do I get rid of this side? Darn. Okay, I'm not going to worry about it. Should we start with exercise 3-1, guys? Oh, shoot. Don't tell anyone. Water's never good for computers, is it? Darn it. Believe me, I go through about 2 laptops a year now. Do you know why? Okay. I'll make a deal. If you don't tell, I won't tell. Okay. Let's do exercise 3-1. Who can read the first one? Isn't it helpful to do some exercises to understand what we're doing? What?
Another packet.
I don't know. Should we give him one? I guess. Martin, you have a bunch, don't you? So, do you think he's going to be getting extra points for being my little...
Yeah, hook it up.
Do you want to sign in too?
Oh,
Here you go. Anyone else need one? Oh, that's my next class. Do you want to come to that next class too? It's not as thick as yours. Okay. Does it help to go over some of these exercises, guys? I think it does. Darn. Okay, the water goes over here for now. At least it's not coffee, huh? Or milk. Okay. Who wants to do the first exercise? Exercise 3-1. Okay, let's see. What chapter? 3-1. Not problem. Exercise 3-1 is on page 140. Selected transactions for Warner Advertising are listed here. Our job is to describe the effect of each transaction on assets, liabilities, and owner's equity. So they give us an example of the first one. We issued common stock to investors in exchange for cash received for investors. What happens to that account? When we receive common stock in exchange for, oh, it's a PDF. I didn't mean to do a PDF. Darn. Can I, darn, how can I, Boy, I thought it was so tough I had it all organized. New folder, Dropbox. That's a doc. Template, I knew I did it in a doc. Open with Microsoft Word. Okay, and this thing is getting in my way. View. Edit, thank you. Little slow. Okay, so what's going to happen here, guys? With we got issued common stock in exchange for cash. What's going to happen to our assets? What specifically is going to increase in assets? Cash. So guys, to make it easy, increase assets. Do you see what I'm doing? Do you guys understand that a plus means increase? And A is for assets, okay? And what's going to happen to stockholders' equity? Increase SE. Do you guys understand my little lingo? Makes it easier. Okay, who wants to take the next one? Paid monthly rent. What's going to happen to our assets? Assets are going down. Do you guys all agree? Assets go down, and what happens to our stockholders' equity? That goes down. What's the next one? Who wants to take another one? Received cash from customers on services performed. What do we think, guys? What's happening to assets? They go up. And what's happening to liability, what's happening to our stockholders' equity? It's going up also. Any questions so far? Are we kind of getting it a little? We're doing okay?